Stop trying to time the market, okay? It's time in the market that counts. So again, there's a famous saying in the property circles, you probably read it in lots of books and so on, probably in general investment terms as well. It's not about timing the market, it's about time in the market. Now, before I get people saying, well, of course it's about timing the market. Yes, you do want to, or should I flip it this way? You don't want to overpay for your investments, of course not. You don't want to be overpaying. But at the same time, if you do end up overpaying in the long run, 10, 15, 20, 30 years down the line, it would have by far cancelled it out. So one of the first investment properties we bought was a 2-bed end terrace in 2007. So we purchased it for 60,000. Now, I was very, very good at not negotiating. I was very, very good at not doing any tenant checks. I was very, very good at getting bad tenants in. I was very, very good at getting cowboy trades in. So I did lots of things wrong during those early days. I definitely had a scarcity mindset. I didn't realize that I needed to continually invest in the assets. Again, lots of mistakes that you may have read about on my blog. Oh, and before I forget, it's dervishdervish.com. That's an old website. So if you do want to have a look at any of the blogs, have a look at dervish.com. So yeah, going back to the main point of the video, really, it's about time in the market. So going back to that 2-bed terrace, we purchased it at 60, didn't negotiate, probably overpaid. And then as a crash hit in 2008-9, it probably went down to about 42,000. I thought it was the end of the world because we had 3 investment properties and they'd all dropped down. But there was something inside me saying, I can't afford to sell these. Well, yeah, obviously I couldn't afford to sell them, but one day it will work out. Now, fast forward 14 years, 15 years, in 2022, so 3 years ago, it's 2025 now, in 2022, we had that revalued comfortably at 120,000. Now, we probably could have pushed it to 130, but I'm always aware of over gearing. I didn't want our LTV, loan to value, to be really, really high. Now, going on from 3 years from that, so it's 2025 now, that property is easily worth plus 140. So we haven't done any major refurbishments in those few years, but that's again about the market. Now, if you think to yourself, 2007 purchased it at 60, 20 years later, well, 18 years later, it's now worth 140. So it's gone up £80,000, more than doubled in that time period, and there's been a massive financial crash in it. It was time in the market. Has it paid us each and every month? Probably 90% of the time, yeah. Have we had to fix new bathrooms, new front doors, new back doors, new kitchens, new boilers? Yeah, of course we have. But we tried to make it as passive and as systemized as possible. That's part of our managing agent side of things, really. Sorry, I keep scratching my nose. But yeah, just be aware that it's about time in the market. Yeah, of course it's time in the market, but the most important thing is time in the market. Have a look at successful investors like Warren Buffett, one of the world's richest men for many, many years. He was always an advocate of not many people want to get rich slow. Not many people will understand the importance of compounding. People always want to get rich quick. But if you're in property, another saying as well is buy, hold forever, or buy, hold and die. That's where the capital growth is. That's where the generational wealth is created, okay? So any of the successful families or anything like that, the people that have got massive multi-million pounds worth of a portfolio, £1 billion worth of a portfolio, it was somebody at one point 50 years ago, 100 years ago, 150 years ago that took that action to start investing, and now obviously future generations are reaping the benefits of that. Hopefully that's going to be you. But yeah, time in the market is important because you don't want to be buying when things are crashing down and you don't want to overpay, but at the same time, it's about the length of time in the market. Some people I speak to say I'm not going to touch anything that don't give a return of more than 25%. Fair enough, but I mean, Warren Buffett, and I know I've mentioned him a couple of times now, he's always round about that. If you're getting an 8 to 10% yield return on your money, fantastic. Just keep it in there. The compound effect will happen and it'll just keep building up and building up and building up. So don't necessarily write off deals because they're giving a return on capital employed or return on investment of over 8%. Just compare that to inflation. Compare it to what the banks are currently giving. What are banks giving now? 0.000001% or something like that. Probably, maybe not even counterbalances inflation. But yeah, just be aware it's time in the market if you're looking for that long-term generational piece. Another story as well, very, very quick one. I remember my granddad's house. He told me this, or my dad told me this story. He paid, I think it was about 3,300 for the house in the early 70s. That's now worth 220, 230. Yeah, of course you've got inflation in there, and of course a pound went a lot more back in those days, but I don't think the gap is that big. Okay, so imagine paying £4,000 for something, then within your lifetime it being worth over 220. So just keep taking steps further forward, keep investing. Hopefully, if you're watching this and you've watched it for so long, you've got that mindset of, keep stacking and building out your assets, keep building up your wealth, and keep collecting that passive income, reinvesting it in. If you like this video, please subscribe to the channel, and just all the best. If you did want to have a look at any of the blogs, again, it's dervish.com. I need to get a new sign, but we'll get round to that. It's more about helping my mentees at this stage, and I probably will get a new sign. All right, take care, everybody. All the best.